Welcome to another edition of our Smart Investing Weekly Stock Analysis, where we break down popular companies using fundamental analysis and provide advice that is truly unbiased and has no strings attached. And, talking about a lot of popular companies, giving out this advice on a weekly basis. If you find this video interesting, don't be afraid to hit that subscribe button below so you can see our future videos as well. Now, I said we'd talk about popular companies. I think this one was one of the most popular during the pandemic. I'm talking about Zoom, of course.
And Chase, it's funny. I just thinking, sitting here listening to Zoom. Last week, you like saying Alibaba. This week, Zoom. Got some great names to kind of talk about. And this is quite the company because it was very hot about probably a year ago. And I do want to point out, it still is a great company, but we've really seen a lot of air let out the bag here. And now, could this be a good investment? We never preview the numbers and pick it by the numbers. We actually see this firsthand with our client or our viewers on, is this a good buy or not? But we think it could be, because I think it's down, I'm going to say 50% from the high.
I mean, it's fallen tremendously, and we'll get into those numbers exactly where it's at compared to its 52-week high. But it grew in popularity. I mean, I'm going to say it was a lifesaver for many people during the pandemic. A lot of people to work, a lot of people to kind of communicate with loved ones. A lot of people, I know some people did Zoom happy hours. I never went that over the top with it, but I know some people enjoyed them.
Yeah, I didn't get Zoom happy hours. I go drink in the closet. I don't know. It makes any sense. Zoom happy hour.
But
drinker, by the way.
Well, what made this interesting was they reported earnings this past week, and it fell like a rock. I mean, the thing is, they reported quarterly revenue that was above $1 billion for the first time in their history. They actually beat on sales, beat on earnings, but the guidance was weak. And this is the problem we always talk about with high growth companies and high growth stocks, is that they're trading at these excessive valuations. The moment that growth starts to dissipate a little bit, that's when that stock can really, really falter, as we saw with Zoom.
Yes, I was going to point out, I did a national TV segment Wednesday, I think it was, and I just assumed we're using Zoom. And when I logged in, it's like, no, not using Zoom, as somebody else. I never heard of BM Text or something, I think it was, but I just assumed that everybody uses Zoom. But there is competition out there, and that could be a problem for Zoom as well.
Well, I know you talk about big players like Cisco, they have WebEx. You talk about Microsoft now. I know people use Microsoft Teams as another example of a competitor. So, Zoom, I'm going to say, was kind of the first of the party here. But actually, I'm not going to say they were the first of the party. WebEx had been around for a while. They were the first really big one recognized, and I think they had the best kind of platform at that time. But as time's progressed, it seems like their competitors really caught up.
Yeah, and I think as Zoom had it to where you got it free, was really kind of marketed towards the individual. WebEx, I don't think they had a free trial service or free service at all. And it was more for like businesses. So I think Cisco, who owns WebEx, kind of missed the big opportunity there, and Zoom just took it and zoomed away with the opportunity.
Well, in full disclosure, this video we're doing right now is being filmed on Zoom. So we use the service. I think it is helpful, especially we have clients all across the country. So it's a nice way for us to kind of communicate with clients that aren't here in San Diego.
Yep. I'm excited. Can I do the numbers now?
Yeah, let's move on. As always, we like to start off with the story of the company, but it really comes down to the fundamentals at the end of the day, if it is intriguing or not for us to buy it.
Yep. Well, let's take a look at the numbers. And first off, we always start with the PE ratio, which stands for price earnings ratio. Very important, how much you're paying for the earnings for the company. No surprise here. Now, these are numbers as of July 31st, so they're not old numbers, they're pretty recent. 89.1, well above the industry at 73.1. I know at the bottom of the screen, it does tell what industry they compete in. I'll try to remember to look at that, because I am curious the industry they compete in. Also high at 73, as I said. We do see price of sales, very expensive, 24.1 versus 13.3. And just to kind of put things in perspective, and normally we compare it to the industry average because we want to compare like companies. But just go further to the right and look at the S&P 500. They're paying 3.1 times sales versus 24. So just kind of show you how high that really is. Looking at the price to book value, 18.9. That's a pretty good, reasonable price to book value, especially compared to the industry of 101. Price to cash flow, 84. Very expensive, double the industry of 41. So the valuation ratios for Zoom, they are zooming to higher levels, that's for sure. But you do get some good growth rates here. And by the way, I see you pointing dividend, no dividend yield, no dividend here. They don't pay a dividend. They're a growth company. That's not unusual for growth companies not to pay dividends. But we do see year over year, the sales are up 170%. No surprise there because it is a very attractive company, a very attractive product feature that they have. 10 times the industry at 17.5, and even earnings up 324%. 10 times also the industry up 32.55. So this was a small company. They are still growing sales, earnings year over year. But I think, as you said in the guidance, the problem is that's starting to taper off. Will this company last? Well, let's take a look at the balance sheet here. We see they got a very nice current ratio of 3.46 versus 1.9. Now, this tells us the company has a lot of liquidity to pay off future liabilities in the next 12 months. Enough in assets to pay those off. So good there. Also, too, glad to see the company's grown themselves with no debt. They've not borrowed a lot of money to build this company. They've done it all through cash flow and earnings and so forth. You compare that to the industry average at 68.89. So a nice balance sheet for Zoom. We do see the equity is a return on equity of a 34.3, and just kind of rounding up there. That is above the industry average at 22.2. Very curious here on profitability. What are they making a profit? The absolute bottom line, pretty darn good, 27.6 versus 18.3. So what that tells the investor, for every dollar Zoom brings in, they keep 27 cents of that dollar, almost 28 cents of that dollar. So that's a big positive there. And then we do want to look at the receivable turnover. Receivable turnover here, 10.5 versus 6.5. I'm not sure how they use receivables. Maybe perhaps on larger companies, they bill them and then they pay it down the road. But even receivables are pretty good for this company. So the numbers look pretty good with the exception of the valuation ratios. So now I'm kind of curious, what are the future earnings look for this company? Can we get a company on sale here?
Yeah, so let's take a look here.
You know what, Chase? And I promised, I try to remember, I just remembered what industry they compete in. So if we can go back and go down a little bit, what industry they're in. They're in the industry of what? Software. And software programming. So that's the industry they compete.
I mean, this could be, again, an example of what we call a great business, just at a very expensive price. And I mean, the numbers look great in terms of their fundamentals. I mean, and I'm talking the fundamentals more of the profit margin, the balance sheet, but gosh, the valuations just almost make it uninvestable at these prices. And the reason I say that is, let's look at the numbers here. Current price, $295.09. You see, I mean, it's taken, I'm going to call it a shellacking, as the 52-week high was $588.84, is trading near the 52-week low of $273.20. And they do report on a fiscal basis. So let's look at January 2023. I look down here, you can see the estimated earnings per share from 26 analysts. Well, that's $4.77. That would give us a target sell price of just $79.18. I mean, the valuations on this company are just out of control. And what it stemmed from, I mean, you talked about this huge exorbitant growth that occurred during the pandemic. I mean, went over the numbers, you're talking in the triple digits. Well, now I believe they came out and said top line revenue, they're expecting to really kind of decelerate to a level of around just 30% growth. And 30% growth, wow, that's tremendous. But to be trading at valuations like this, I mean, you need to have growth that is just mind blowing. And I talked about the competition. We talked about the competition already. I don't know if they're going to be able to really still justify the multiples that they trade at, even with the major pullback.
And you may want to talk about it, Chase, but I did notice the big range of earnings of those. You got 26 analysts, very good, but the range of their estimates all over the board, that's not a good thing.
Yeah, and you see here the high is 554 and the low is 296. And we talk about this because if the range is quite large, it gives us less confidence in a number. You like to see a tight range because it kind of means the analysts are all on board with that. But you could have one guy that's, saying, and I'm not saying this is going to happen, but Microsoft Teams is going under, so Zoom is just going to keep growing through the moon. Another guy on the bottom end could be saying, well, I think that Teams is going to replace Zoom. So they'll kind of have these really big differing opinions on that. I like to see a tight range, not a wide range like we see here with Zoom.
Yeah, and competition is such a big factor for people. And again, we always talk about not getting too excited about companies, get stuck into the hype. And we haven't talked about it here very recently, but the greater fool theory, where you buy a stock at a high price, hoping there's a greater fool out there going to pay a higher price than you paid for it. That's not a good investment philosophy. And it does worry me. I mean, Microsoft, they could easily spend $1 billion marketing this, which would really put them way on the forefront, putting perhaps Zoom out of line. One thing that maybe could happen, I don't know, maybe Microsoft bought Zoom. That's another possibility. Unlikely, I think, because I don't think they would do that, but a lot of things can happen.
Or one of Microsoft's competitors buys Zoom, like maybe, but even they have Google Meet now, which I used for the first time this past Wednesday, and I can't tell the difference, to be honest. I mean, I went on there and clicked the link, and wow, now you're video chatting. I mean, I don't know.
That was the Google Meet that you tried?
Yeah, the Google Meet. Yeah. So there's a lot of different things out there. I don't know enough about the back end of software to tell you that there is these huge astronomical differences between it. But from the consumer standpoint, I can tell you, I haven't noticed any difference if I use Zoom or if I use Google Meet or if I use Microsoft Teams. I mean, they all seem to kind of accomplish the same goal from the consumption standpoint.
You know, we often talk about the moat. You want a business that people can't replicate and so forth. Well, this is so easy to do, to just do it again. Again, you just made two companies that are doing it. There could be many other companies doing it as well. And you took the numbers down, but I mean, I did kind of glance going out further beyond what 2023 and so forth. The earnings don't grow by much at all based on what they were seeing, and they could actually be a reverse there.
Yeah.
Yeah, look at what was it? Because you looked at what the January 2022,
I look at 2023.
2023. Yeah, so January 2024, they dropped down to 512. Just not that big growth you'd be looking for. Now again, less analysts, but still to justify the multiple that they're trading at, you've got to have some good growth. I just don't see how they're going to do it. I'm kind of disappointed because I would love to say we have Zoom in the portfolio, but I just don't see the growth there. And I think this is really going to burn a lot of growth investors thinking like, yeah, they did so well over the last year. Competition is going to come in. I just don't think they're going to do as well.
I don't really want Zoom in the portfolio, to be honest.
Well, if it was a good buy, I would, yeah, but not at these levels. But say it was, like 10 times earnings, like, oh yeah, that'd be pretty cool to have because then we can say we have Zoom. But it's just like you got to be careful. That's an emotional decision I'm saying there. But when you do the numbers, no, we would never own Zoom at these levels.
Yeah, and it happened all through last year. Oh, we should buy Zoom, and it went up and it went up and it went up, and it's like numbers just don't make any sense. And you never know, as you said, with that greater fool theory, who's going to be the greatest fool?
Yeah.
And you never know when that greatest fool is going to come in and really set the high water mark. And from there, it can just be a waterfall off the edge, and the numbers, the stock price just keeps sliding. So be careful of it.
Yeah.
I wouldn't recommend going near Zoom and then doing your Zoom conference calls there.
Yeah, I'm just kind of wondering how many investors still hold Zoom that they paid $500 or more, hoping it's going to turn around and go back above that. I think I'll be waiting a long time, if maybe forever, because based on what we're seeing competition, I don't think we'll see those numbers. So if you hold it, you may want to kind of really strongly the numbers because and again, we just talked about things as well that, you know what, you might be holding this hoping you get to the pray and hope game. Sometimes it's better to cut your losses and find another business that has some potential to increase over the next 12 to 24 months. Because Zoom, you're going to be hoping for a long time, missing perhaps other good opportunities.
Yeah, well, I think we're in agreement here. I think Zoom's a no-go. But thank you for joining us today. If you like the content, please be sure to subscribe to our YouTube channel for upcoming stock videos. This should not be used as investment advice, as it is for informational purposes only. If you're interested in learning more about our investment philosophy or our company, Wilsey Asset Management, please visit our website, smartinvesting2000.com. Again, that is smartinvesting2000.com. We'll see you next week.